So I thought it would be an interesting video for me to shoot while I had the chance to do it. I'm in a condo that I bought originally as an investment property. I ended up living here for a little while. No, not that big, but what ended up happening is that I stood here for a while. My parents ended up living in the area, and they're older, so I stood here for a period of time. But what happened is that the reason why I'm making this video, I just thought it would be interesting because I want to talk about cycles, and this condo is a pretty good indication of cycles. I bought it at the last cycle low, and I don't know who's watching this and what their experience is, but back in 2008, 2009, obviously we had a real estate market crash, which everybody thinks isn't going to happen again, which maybe they're right, I have no idea. But what ended up happening is that probably took 2 or 3 years for the cycle to bottom, even though obviously we had markets themselves actually hitting bottom. I guess it was in March '09, but real estate actually took a while to unwind. I picked this up in actually 2013, and the price at the time was about, I negotiated down to 70 or 72,000. I'm not really sure which one. I think it was 71.5 or something like that. And now all of a sudden I have it listed and I think it should be selling. It's under contract and we were supposed to close this past week, but it ended up being delayed because of the title insurance issue. But at the same time, I think it ended up selling. We ended up selling for 250. I made some concessions, so let's say 248, something like that. But the point being is that I held it for about 11 years or 10 years, and I basically went up 325%, which makes no sense. All right. Originally, when I bought this place, I paid 71 because I bought it because I knew as an investor, one of the persons I was speaking to owned another place in the same complex that I guess it was 8 years prior to me buying it, they paid 200 for theirs. So I know the intrinsic value that would probably not necessarily go back up. And then when it hit my target of 200, I started looking for another place to live because obviously I didn't have to be here anymore. But at the same time, trying to find something that I specifically want because I have a motorcycle and I have other little toys that I need a place to store. So trying to find something wasn't as easy to do, but something ended up coming up and I took it and I put this on the market. But the point I'm trying to make is that you don't want to pay attention to cycles. We're at that same type of cycle high now, possibly the stock market. Again, I'm not saying it's going to end tomorrow. Maybe it's going to keep on going up. But again, when you end up starting to see values get pushed to the extreme or stretched, right now we're working with maybe a P ratio in the market, not on the actually housing market, but on the stock market itself of SPY is probably about 27 to 30, we'll say at this time. And you're talking about over the past year or two, we'll say returns in the area of 70%. I don't have the numbers right in front of me. I didn't bother looking them up since I was really just going to talk about this space today. So many people out there, it's so funny because the real estate market now is basically, it seems like in a neutral zone because with interest rates being so high, nobody really wants to actually bid the price up any more than what it's already at. So in my area anyway, I don't see prices going up, but I see them neutralizing. But you've changed the consciousness of investors and or purchases to where real estate isn't going to go anywhere. And it's so interesting because I belong to a real estate group and everybody in there is like, Gary, you're wrong. Prices aren't coming down. Prices aren't coming down. It's like, okay, fine. All I can say is that I can't buy at this level because I look for a certain yield from everything I buy. I have to end up, some of the authors out there saying you make money when you make the purchase. You don't make the money when you sell. But when you initially get into the space, that's when you're making your money. And you're not, when I bought this place, you were making money. I think it was yielding about 9-10%. Right now, obviously, with the amount that I paid for it, I could probably make about 22%. But that's obviously after the fact. If I pull money out of it, you can get to the point of infinity because that's obviously what an investor works for. But nonetheless, I'm selling it because what happened is that I don't know if anybody's familiar with the tax advantages one way or another, but once it turns into investment property, then you have to actually declare capital gains and depreciation. Obviously, it could be more or less, what's that called when you, I guess it could be amortized depending how long you hold it for. But since it was already characterized as a personal residence, I had other property down the shore at one time when I sold it, right before I sold it, though I moved in there for 2 or 3 years. And so the actual title of the property switched back over to a personal property versus actually instead of investment property, which then I didn't have to pay back. You can claw back all the capital gains and obviously the depreciation I took on the property for, I think it held it for 15 or 20 years, 15 years. So that's what, this is basically a decision. I figured I'd cash out now and I basically actually wait if that turns out to be the situation. If not, no problem, but because I could just get back into another property if I choose to. But at the same time, since this is what I do, I figure, you know what, I'm playing the game. And I found a nice place that I want to be in with the garages and things for my motorcycle and whatever. And you know what, I'm going to hang out for a little while and do my trading and maybe apply this to something that's going to be counter trending. Maybe if I believe, that nail is going to actually rip up, maybe I'll go a little bit heavier than what I'm in it right now. I don't know whether or not that's going to actually, nail is, if anybody doesn't know, it's an ETF actually that goes along 3x the home builders. And I went short at different price points that I was planning on maybe taking a bigger position short, but who knows? I don't know which way I'll go, and that's why I don't like to give positions at this time anyway on this channel or on this site, because my positions change so much that once I say something, I don't want anybody, God forbid, to follow me and all of a sudden get burnt because of it. It's interesting because when you actually relate to what's going on now with Paul Tudor Jones and obviously Drunken Miller being short bonds, I mean, if somebody ends up saying, wow, they're short bonds, so I'm going to get into the trade, those guys are so sophisticated that they could be short bonds today and yet long bonds tomorrow. You don't really even know what their book is. When you look at what Goldman Sachs did during 08 or 09, the company itself was actually short the CDOs and or the mortgage-backed securities, MBSs, and yet at the same time, they were still selling it to clients as I think AAA paper or A-rated paper. So you don't know what somebody's actually doing themselves as far as their book is concerned. So, I pay attention to this stuff. I just don't trade on it. So in other words, if I was to say that I may think about going short the nail ETF, it's okay, you could pay attention to it, but don't make any moves based on that because you just never know if you're right. I mean, also, in other words, I've been working on this TLT position. I thought that I was absolutely right on this position I was waiting for the past 6 months, whatever it was, and finally the trigger got pulled, I guess in September, whenever that Powell actually lowered interest rate half a point. I'm like, here we go, and boom, I loaded up, and again, I wasn't full, but I was at 50-60% invested, and man, just since then it's been going against me. I had a cover, and I actually just rearranged things, scale in, scale out based upon what I see. I still think it might be a viable trade down the road, but to me the trade is asymmetrical, so I take it. I think there's 10-50% downside, but I think there's a good 30-40-50% upside. So this is kind of trade I look for, so that's the only reason why I'm a little heavier in that position than I usually would be. But getting back to the piece of real estate is concerned, pay attention to cycles, because this is going to be something that's going to be very helpful for you. And if you're young, don't think that cycles don't exist. My first house third house I'll say I bought, all right, I ended up making out on the first couple properties, but my first property I bought when I was 21 years old, down the beach area, right? I paid 61 thousand for it, I think, something like that. It went up to 85, 87 or something like that in 1986, 80, 90, 89. I don't remember the exact date, but the point being is that by 1992, plus or minus again, the price was $35,000. I remember getting a piece of paper in the mail, the person saying to me, oh, you can own this condo for the price of a car. Just, you could actually put it on your credit card if you want to. And you know what? I was an idiot enough to say, you know what? I want it for $25,000. So I waited longer, and then obviously now it's $300,000 or $400,000, whatever. Beach property is very, expensive at this point. But no, considering what this beach property is more expensive at $300,000-$400,000, but it was only when I originally bought this first property, 20 years old, I think, I guess it was classified as an efficiency apartment. It was an apartment condo conversion, from a motel. So it was all I could afford at 21 years old. So I got my realtor's license and I went searching for something I could afford, and that's what I bought. But the point being is that look at how dramatic that was as far as a drop is concerned. Intermittently, what happened is that I also bought another property that I went from 60 to 90, and I did cover that one. I did sell it. So I made out somewhat in the boom. But I had to hold that beach property from, we'll say 1985, 1987, whenever I bought it, to 2000, 2002. I don't really remember exactly what day it was. I think it might have been 2002. I'm not too sure. So And again, it doubled, I guess, by the time I sold it, which then, my down payment was maybe 17. So obviously doubling it, making 110, 120, whatever I made. I mean, obviously it was an amazing return on my investment. And at the same time, I rented it out pretty much the whole time I had it. So, which was an experience in myself, which damaged me because, that's the thing that's so interesting these days when people will actually buy property and rent it out for like a 3 or 4% cap rate. I'm like, you know what? If you're willing to do that, either you're a professional or you don't know what you're doing. It's one or the other. If you're a professional, you don't care because you're in the game and you have to keep on just maybe building your portfolio. But if you're if you haven't been in the game before, taking care of tenants for a 3 or 4% return, unless there's something else, maybe the financing was wonderful, maybe the deal itself was structured in a way that maybe you had to put nothing down, then that's a different story. If you make 3 or 4% on nothing down, that's a lot more than 3 or 4%, obviously. But the point I'm trying to make is that it has to be worth it for me to get involved in doing something that involves that kind of, I guess, involvement, if that's kind of a lame way to put it. But for me to be involved in a deal or a project, it has to be something that's going to actually be worth my time. And stress, that's pretty much the biggest thing because you're dealing with other people. And if you're a people person, then maybe this is easy for you. One of my friends, he's actually in the real estate business and he got involved at like maybe 25, 26, and he just handles it very well. He's very much legalistic. So he just goes by the rule book, presents the rules to the person, follow the rules. And he's not in New Jersey. So basically what he says he goes because New Jersey is harsh as far as to the landlord is concerned. Where he is in PA, it's like you get to do what you want to do. I mean, not as free as other states like maybe Arizona or Texas, but Pennsylvania, where he is anyway, in his situation, seems to be pretty good. So anyway, getting back to cycles, pay attention to them. They do exist. They happened in 1985. They happened again in 2008, 2009. And I believe we're at the top of another cycle. But we'll see. I mean, God willing, the person that owns this property makes good money going forward for himself. But I think he's pretty much like me. I don't know, but he's buying a cycle that I necessarily for myself. He's going to live here, but I would have done the same thing when I was his age because I wanted a place to live. But being an investor and moving money around, to me, it's time to say, you know what? The price point that I wanted got triggered. I'm saying, you know what? It works for me. If it didn't work for me and I couldn't find a place to live, then I would have stood here. It would have made no difference to me. It's a nice place to live. But if it gave me that opportunity to get out, then I'm taking it. But I hope somebody gets something from that. And if you have any questions, please put them in the comments. And if I can figure it out how to do that, I'll answer them. Thank you.